To understand what's happening now, we need to zoom out. Silver just broke above $50, a level it had not sustainably cleared in half a century. From 1980 through 2025, silver was locked inside a range between roughly $4 and $50. Every time it approached the upper end of that range, it was rejected in 1980, again in 2011. Over and over for 50 years, that ceiling held. And during that same period, nearly every other major commodity eventually escaped its long-term range. Gold moved well beyond its prior highs. Copper spent decades capped, then broke out in the mid-2000s and more than tripled. Lead followed a similar path. The pattern is consistent. Long compression phases eventually resolve with powerful repricing. Silver was the exception. For 5 decades, it remained the only major commodity still confined to its historical ceiling. That kind of compression matters. When an asset is held within a narrow range for that long, the release is rarely gradual. The stored pressure doesn't resolve with a modest move. Historically, it resolves with rapid, outsized repricing. That's not an opinion, it's visible in the data. Looking back at silver's major advances confirms this. From late 1979 into early 1980, silver moved from roughly $12 to $50, a 4-fold increase in about 5 months. In the 2010-2011 cycle, silver doubled in roughly 7 months. In both cases, the majority of the gains occurred in a short window, not over years. Both advances also shared another feature, a sharp correction in the middle, a violent pullback that convinced most participants the move was over. That shakeout removed weak positioning before the final acceleration phase began. Now look at the current structure. Silver began accelerating in late 2025. November marked the initial breakout phase. December followed with continuation. By late January, price surged above $90. Then came the collapse. Fast, aggressive, and emotionally destabilizing. Structurally, this mirrors prior cycles almost precisely. Initial acceleration, early continuation, a violent correction, and historically, that correction has preceded the strongest phase of the move. If the pattern holds, and it has twice before with remarkable consistency, the primary advance occurs in months 3 through 6 of the cycle. That places the highest probability window between late spring and early summer of 2026. But this cycle carries an important difference. In both 1980 and 2011, silver's advance was capped by the same long-standing $50 ceiling. This time, that ceiling has already been broken. And notably, even after the sharp correction, silver did not return below it. The former resistance level has become support. That transition matters. It suggests that the market is no longer operating under the same structural constraints. The prior range is no longer the governing framework. Silver is building above it. Now let's address a mistake many analysts are making. After the crash, a number of voices cited momentum indicators, RSI, oscillators, overbought readings, as justification for exiting positions. And from a short-term technical standpoint, those signals weren't wrong. A correction did occur. The issue is context. Those tools were calibrated for a market that existed when silver was range-bound. Momentum readings that once signaled exhaustion inside a capped range don't carry the same meaning after a structural breakout. Using legacy indicators in a regime change often leads to correct short-term calls and incorrect long-term outcomes. Monthly momentum has already exceeded levels seen at prior cycle highs. That suggests the market has entered a new phase, one where traditional overbought thresholds lose relevance. This creates a familiar outcome. Traders exit correctly during a pullback, but fail to re-enter when price moves higher. The psychological barrier becomes too high, and the largest portion of the move occurs without them. At this point, participants fall into 3 categories. Those who sold during the crash and hope the move fails, those who held through the volatility and are seeking confirmation, and those who stayed on the sidelines waiting for a perfect entry that may already be gone. The pattern doesn't respond to any of that, it responds to structure. Now consider what's happening in the physical market. Shanghai silver prices are trading roughly $30 per ounce above Western benchmarks. That's not a temporary anomaly. It reflects sustained physical demand at prices well above futures quotations. At the same time, China has implemented export controls limiting refined silver exports to a small group of approved entities. The result is that a majority of refined supply is effectively retained domestically. Physical availability outside Asia is tightening. Reports from bullion dealers reinforce this. Some are warning clients of delivery delays or pricing adjustments below spot due to sourcing constraints. When physical premiums diverge this far from paper prices, history shows the paper market eventually adjusts upward to close the gap, not the other way around. Now, layer in demand. Silver operates on two demand channels. Industrial use is the first. Solar manufacturing, electronics, medical applications, and AI infrastructure all rely on silver. Global supply has failed to meet industrial demand for 5 consecutive years. Once used, much of that silver is not economically recoverable. The second channel is monetary. India's central bank has announced regulatory changes allowing silver to be recognized as bank collateral beginning April 2026. That represents formal monetary recognition of silver by a major economy for the first time in generations. It introduces potential monetary demand from a population exceeding 1.4 billion people. When silver is treated only as an industrial input, demand grows incrementally. When it begins functioning as a monetary asset, demand behavior changes entirely. Gold has already been reflecting this shift. Silver historically follows with a lag. That lag is currently extreme. The gold to silver ratio remains near historical outliers. Each prior instance of this imbalance has resolved through silver outperforming gold, often rapidly. Now step back further. The US dollar index has broken a long-term structural trend line that held for over a decade. This isn't a collapse, it's erosion. But when combined with sustained expansion of the money supply, the long-term implication is clear. Purchasing power continues to decline. Precious metals don't just rise during these periods, they reprice to reflect accumulated dilution. Meanwhile, the government bond market is under strain globally. Debt levels are pushing investors to reassess what constitutes safety. When confidence in sovereign debt erodes, capital historically seeks refuge in tangible monetary assets. Finally, consider relative performance. Over recent months, equities have moved sideways while commodities and precious metals have continued to outperform. This signals asset rotation. Capital is shifting quietly, not impulsively. When retail attention arrives, it typically arrives late. Putting it all together, structural breakout, physical premiums, constrained supply, dual demand waves, monetary policy stress, and asset rotation, this is not a single factor story. It's convergence. None of this removes risk. Silver remains volatile. Corrections can be violent. Leverage amplifies losses. Patterns can fail. But when multiple independent signals align across price structure, physical markets, monetary policy, and historical precedent, the probability distribution shifts. The next few months matter.